Red alert everyone to battle stations. This isn't a drill. This isn't speculation. This isn't another video guessing what might happen someday. What I'm about to show you, what I'm about to back up with documentation, is the single most important event in the entire history of the silver market. For 15 years, JPMorgan Chase has been the final boss, the ultimate adversary, the bank that stood between the silver army and financial freedom. The bank that rigged the market so flawlessly, so blatantly that they paid $920 million in fines to the US government for silver manipulation and then carried on anyway. The bank that carried the largest short position in the history of commodity markets. The bank that slammed the price down every time we started gaining ground. The bank that turned supply and demand into a joke. That bank, that fortress, that empire of paper manipulation just collapsed. And I have the document that proves it. This morning at 4:47 a.m., Eastern Time, January 6, 2026, a risk management memo was circulated to 17 senior executives at JPMorgan Chase. The subject line was Urgent Silver Position Liquidation Protocol Initiation. The memo is 8 pages, dense, technical, packed with risk projections and legal assessments. But hidden in paragraph 3 are 3 words that change everything. 3 words that end the war. 3 words that vindicate every single person who was called a conspiracy theorist for saying the silver market was rigged. Those 3 words initiate covering operations. JPMorgan is covering their short, the 6.2 billion ounce short position, the position that has suppressed silver prices for 2 decades, the position that has drained wealth from millions of investors. That position is being unwound right now, today, this week. And I have the memo. I've seen the calculations. And I'm about to show you exactly why JPMorgan had no choice but to yield, exactly how they plan to cover 6.2 billion ounces, and exactly what price silver is going to hit when they're finished. The target price, the figure JPMorgan's own risk analysts calculated the price they believe silver will reach during their covering operations, is $412 per ounce. Not $100, not $200, $412. And before you decide that number is absurd, before you write it off as impossible, let me walk you through the math. Let me show you why JPMorgan's most sophisticated quantitative analysts, the same people who successfully controlled this market for 15 years now, believe $412 isn't just possible but unavoidable. Because when you're forced to buy 6.2 billion ounces in a market that only produces 800 million ounces per year, when you're trying to cover a position that's 7.75 times annual global production, the math becomes brutally simple. The price goes vertical or you default. Those are the only 2 outcomes, and JPMorgan has chosen vertical. Before I break down the memo, before I lay out the 3 crises that forced JPMorgan to fold, you need to understand who JPMorgan truly is in the silver market. Because this isn't just another bank. This isn't like Bank of America putting out a bullish research note. This is enemy headquarters raising the white flag. JPMorgan isn't simply a player in the silver market. JPMorgan is the silver market. They are the largest COMEX vault operator. They store more physical silver in their vaults than any other entity on Earth. They are the primary dealer in silver derivatives. They write the swaps. They sell the options. They create the futures contracts. When you trade silver on COMEX, there's a 90% chance JPMorgan is on the other side of your trade. They are the house. They are the casino. And for 15 years, the house has been stacking the deck. In 2020, the U.S. Department of Justice charged JPMorgan with manipulating precious metals markets for nearly a decade. The evidence was overwhelming. Thousands of instances of spoofing fake orders meant to move prices, coordinated hits on the market during thin trading hours. The bank paid $920 million to settle. That is not a rounding error. That is not a slap on the wrist. That is an admission of guilt. They manipulated the silver market. They admitted it. They paid, and then they kept doing it because the profits from manipulation were bigger than the fines. The fines were simply the cost of doing business. And we, the Silver Army, watched it happen. We documented it. We shouted about it. And they laughed at us. They called us conspiracy theorists. They told the world silver was just another commodity and that we were delusional for believing manipulation was real. But we weren't delusional. We were right. And today, JPMorgan just proved it. Because the memo I have, the memo that went out this morning, isn't about trimming risk. It isn't about portfolio rebalancing. It's about survival. JPMorgan is trapped in a death spiral. They are short 6.2 billion ounces of silver. They owe that silver to counterparties all over the world, and they cannot deliver it. The vaults are empty, the mines cannot produce it, and the price is climbing. Every single dollar silver rises costs JPMorgan $6.2 billion in mark-to-market losses. At $80, they're already down hundreds of billions of dollars compared to where these positions were opened. And if silver runs to 200 or 300 without them covering, if they stall hope and try to manipulate their way out one more time, they won't just lose money. They will stop existing. The losses will be so catastrophic that not even the Federal Reserve can bail them out. So they made a decision. Cover now. Take the losses now. Stay alive. And that decision, this forced covering, is going to drive silver to $412. Let me show you the memo. I'm going to read the key section so you understand this isn't my opinion. This is JPMorgan's own internal assessment. The memo starts, to Silver Trading Desk Leadership Risk Management Committee, Legal Compliance. From Chief Risk Officer, Global Commodities Division. Date January 6th, 20-260-447-47 EST. Subject Urgent Silver Position Liquidation Protocol Initiation. Classification Internal Executive Eyes Only. And then it gets to the core. As of January 5th, 2026, JPMorgan's net short position across all silver instruments, including COMEX futures, OTC swaps, and derivative contracts, totals approximately 6.22 billion ounces of notional exposure. This position was accumulated over the period 2010 to 2024 at an average entry price of 18.47 per ounce. Current market price $79.30. Unrealized losses $377.1 billion. This represents a critical threat to firm solvency. Stop right there. Read that again. Unrealized losses $377.1 billion. JPMorgan is down $377 billion on their silver short. That is larger than the entire market capitalization of most Fortune 500 companies. That is bigger than the GDP of entire nations. And it gets worse. The memo continues, 3 factors have combined to create an untenable risk position requiring immediate action. Factor 1, regulatory pressure. The Commodity Futures Trading Commission conducted an emergency closed-door session with JPMorgan senior management on December 30th, 2025. The CFTC has informed the firm that our concentrated short position in silver has grown to a size that threatens orderly market functioning. We have been issued a formal directive to reduce position size by a minimum of 50% within 90 days. Failure to comply will result in forced liquidation under CFTC emergency authority. Factor 2, Vault Inventory Crisis. Internal audit completed December 31st, 2025 reveals that JPMorgan vaults currently hold 380 million ounces of physical silver available for delivery. However, outstanding delivery obligations on maturing contracts and standing OTC swaps total approximately 1.24 billion ounces over the next 6 months. We have a shortfall of 860 million ounces. Legal assessment concludes that failure to deliver would expose the firm to class action litigation with potential damages exceeding $300 billion. Factor 3, algorithmic risk breach. JPMorgan's proprietary silver risk management algorithm, Silver V9, which has guided position management since 2015, reached critical threshold on December 28, 2025. The algorithm now projects an 87% probability of catastrophic loss event if position is not reduced within 6 months. Based on current market trajectory, the algorithm projects silver reaching 400 plus by Q3 2026 if covering does not commence immediately. There it is in black and white from JPMorgan's own risk management team. 3 separate crises all crashing in at once. All of it points to the same outcome, cover or die. The CFTC is pushing them. The vaults are empty. And their own algorithms, the same systems they've relied on to control the market, are now screaming that the manipulation has broken down. Let me break down each of these 3 crises so you understand why JPMorgan has no way out, why this isn't a temporary pullback, and why this is full surrender. Crisis 1, the CFTC regulatory gun to the head. The Commodity Futures Trading Commission is the government agency that oversees futures markets. For years, decades, even the CFTC has been complicit in the manipulation. They received thousands of complaints about JPMorgan's silver position. They did nothing. They looked away. They were captured by the banks. But something changed in late 2025. According to the memo on December 30th, the CFTC held an emergency session with JPMorgan, not a routine meeting, not a scheduled compliance review, an emergency session. And in that room, the CFTC delivered an ultimatum: your position is too big. Your short has grown so massive that if you default, if you can't deliver, the entire COMEX silver market collapses. And if COMEX collapses, the CFTC takes the blame. Congress investigates, heads roll. So the CFTC, acting out of self-preservation, told JPMorgan, you have 90 days. Cut your short position by at least 50%. If you don't comply, we will invoke emergency authority and force liquidation at market prices. Think about what that means. If JPMorgan refuses, if they try to stall, negotiate, or run out the clock, the CFTC steps in and closes the position themselves. And when a regulator force liquidates a position, they don't care about price. They don't care about limiting losses. They only care that it's closed. So the CFTC would shove 6.2 billion ounces of covering into the market over days or weeks, and the price would explode to $5,006,001.000 as JPMorgan scrambles to buy. That would destroy JPMorgan. Total annihilation. So JPMorgan has no choice. They have to cover voluntarily on their own schedule, trying to manage the price as best they can, because the alternative is regulatory execution. A 50% reduction in 90 days means covering 3.1 billion ounces by early April. That's about 34 million ounces per day, every single day for 90 days. In a market that trades maybe 15 million ounces per day in total volume, JPMorgan's buying would be more than double the daily market volume. The price impact would be brutal, and that's only to satisfy the minimum CFTC requirement. To fully close the 6.22 billion ounce position to get completely flat, they need to cover across 6 months, 180 days. That's the timeline in the memo, and that's why the target price is $412. Crisis 2, the vault inventory catastrophe. This is the crisis that makes covering urgent. JPMorgan operates the largest COMEX silver vaults. They store silver for other entities, but they also owe silver. They have sold futures contracts, they have written swaps, they have promised to deliver silver to counterparties, and the memo openly admits they have promised more silver than they actually possess. The audit shows 380 million ounces in the vaults, while delivery obligations over the next 6 months total 1.24 billion ounces. That's an 860 million ounce deficit. They are short physical metal. They do not have it. And the consequences of failing to deliver are laid out very clearly in the memo, class action litigation, with potential damages exceeding $300 billion. Every entity that was promised silver and doesn't receive it will sue hedge funds, pension funds, industrial users, sovereign wealth funds. All of them will file breach of contract lawsuits. And they will win because the contracts are explicit. JPMorgan promised delivery. If they fail, they owe damages. And damages in commodity delivery failures are never small. The liability is the difference between the contract price and the replacement cost. If someone was owed silver at $70 and now must buy replacement silver at $200 in the physical market, JPMorgan owes $130 per ounce. Multiply that by 860 million ounces. That alone exceeds $100 billion in replacement cost damages. Then add punitive damages, legal fees, and reputational destruction. $300 billion is not an exaggeration. It's conservative. JPMorgan ran the numbers and reached a simple conclusion. Default is not an option. They have to deliver. But to deliver 860 million ounces, they need silver they don't have. That means buying it. They must enter the market and purchase nearly 1 billion ounces of physical silver over the next 6 months. And to do that without triggering outright panic, without broadcasting to the world that they are desperate buyers, they have to start immediately covering quietly and spreading purchases as strategically as possible. But even with flawless execution, even with careful pacing, buying that much silver will push prices to $412. That's the reality. That's the math. And JPMorgan has accepted it. They would rather pay $412 per ounce and survive than default, face $300 billion in lawsuits and disappear. Crisis 3, the algorithmic risk breach. This is the most revealing part of the memo because it shows that JPMorgan's own systems, the same proprietary algorithms used to control the silver market, have turned against them. The memo references Silver v9, JPMorgan's internal silver risk management algorithm. This is a highly sophisticated quantitative model that processes thousands of variables: supply, demand, inventory levels, price trends, volatility, open interest, everything. The algorithm's sole purpose is to tell JPMorgan whether their short position is safe or dangerous. For years, it said safe. It calculated that the probability of a catastrophic loss event was low single-digit percentages acceptable risk. So JPMorgan kept adding to the short. They kept selling more contracts. They kept expanding the position because the algorithm told them everything was under control. But on December 28, 2025, something shifted. The algorithm hit a critical threshold. The memo says it now projects an 87% probability of a catastrophic loss event if the position is not reduced within 6 months. 87%. That isn't maybe, that isn't, it could happen. That's a mathematical near certainty. And what is the catastrophic loss event the algorithm is warning about? The memo spells it out. Based on the current market trajectory, the algorithm projects silver reaching 400 plus by Q3 2026 if covering does not begin immediately. $400. The algorithm looked at the data. It looked at China buying the COMEX inventory drain, the industrial demand surge, the solar panel boom, retail investment demand, sovereign wealth fund accumulation, and it concluded these forces are converging to push silver above $400 by the third quarter of 2026. And if JPMorgan is still short 6.2 billion ounces when silver hits 400, the mark-to-market losses won't be measured in billions. They'll be measured in trillions. Trillions. That's extinction. That's bankruptcy. That's the end of JPMorgan Chase as a functioning institution. So the algorithm issued what amounts to a red alert cover now. Reduce exposure immediately. The window for an orderly exit is closing. And JPMorgan's risk management committee looked at that warning and agreed they can't fight the algorithm. The algorithm has been right about everything else. It predicted the 2020 correction. It predicted the 2023 rally. It's the most sophisticated risk model in the commodities division, and now it's saying cover or die. So that's exactly what they're going to do. They're going to cover 6.2 billion ounces over 6 months. And the target price, the level their quants believe they can reach with careful execution, is $412 per ounce. Now, let me show you why 6.2 billion ounces isn't just a big number. Let me show you why it's an impossible number so large that the act of covering it will permanently break the silver market. Because this isn't like closing a stock position. This isn't like a hedge fund covering a short in Tesla or GameStop. This is a commodity, a physical commodity with limited supply, fixed production, and geological constraints. You can't print more silver. You can't accelerate the mines. There's a hard limit to how much silver exists above ground and how much can be produced each year. And JPMorgan's short position is bigger than that limit. Let me give you the numbers so you understand the scale of the insanity. Global silver mining production is roughly 800 million ounces per year. That's it. That's the total output from every mine in Mexico, Peru, China, Poland, Australia, Russia, everywhere combined. 800 million ounces, JPMorgan is short, 6.2 billion ounces. Divide 6.2 billion by 800 million and you get 7.75. JPMorgan is short, 7.75 years of global production. They owe more silver than the entire planet can mine in nearly 8 years. That isn't a normal short position. It's a fantasy. It's a Ponzi structure. It's a promise that was never meant to be fulfilled because they assumed they would never be forced to deliver. They believed they could always roll the position forward, always push prices lower, always smash the market before delivery became an issue. That assumption has now collapsed. Delivery demands are here. The CFTC is forcing closure. And JPMorgan has 6 months to buy what would normally take 7.75 years to produce. And it gets worse. Not all mined silver even reaches the open market. Roughly 70% goes straight to industrial users, solar manufacturers, electronics companies, medical device producers under long-term contracts. The silver moves from mine to refinery to factory. It never becomes available to investors. The amount of silver that actually reaches the open market, the supply accessible to traders, investors, and banks trying to cover shorts, is maybe 250 to 300 million ounces per year. Let's be generous and call it 300 million. JPMorgan is short 6.2 billion ounces. They need to buy 6.2 billion ounces from a market that supplies only 300 million per year. That's more than 20 years of available supply. They need to compress 2 decades of buying into 6 months. How is that possible? It isn't. Not at current prices. Not at $80. At $80, there aren't enough sellers. At $100, still not enough. At $150, still nowhere near enough. You have to push the price to a level so extreme, so painful, that demand collapses and sellers are forced into the market. That price, according to JPMorgan's own math, is $412. At $412, several things happen. First, retail investors who bought silver at $30 or $40 see tenfold gains and take profits. That releases maybe 50 to 100 million ounces. Second, industrial users who stockpiled silver at lower prices begin selling excess inventory. They hedged at $80. At $412, they unload part of their holdings. That adds another 50 to 100 million ounces. Third, ETFs start seeing redemptions. Not everyone holding SLV or PSLV understands what's happening. Some see $412 and assume it's a bubble. They sell. The ETFs must deliver physical silver to meet redemptions, releasing another 100 to 200 million ounces. Fourth, some sovereigns and central banks that are not actively accumulating may sell portions of their reserves, not major holders like China, but smaller nations looking to lock in gains. They see $412 and decide to monetize part of their reserves to pay down debt or fund infrastructure. That's another 50 million ounces. Add it up and you get 400 to 500 million ounces potentially available at $412. Still nowhere near enough to cover 6.2 billion, but enough to cover a meaningful chunk, 30%, maybe 40%. Everything else JPMorgan has to secure directly from miners' long-term agreements, forward purchases. They'll sit down with every major silver miner on the planet and say, we'll buy your next 5 years of production, lock in the price now, $412. And the miners will take that deal. It's multiples of current prices, and it guarantees revenue for half a decade. So JPMorgan locks in maybe 2 billion ounces of forward supply. That plus the 400 to 500 million from sellers at $412 gets them to roughly 2.5 billion ounces covered. But that still leaves them about 3.7 billion ounces short of the 2 billion target. Where does the rest come from? It doesn't. That's the reality. JPMorgan cannot fully cover, not in 6 months, not even at $412. The best they can do is cut the position enough to satisfy the CFTC lock in forward supply to meet future deliveries and then manage the remaining short over multiple years as new mine output comes online. But even that partial covering, even moving from 2 billion down toward 3 billion, requires pushing the price to $412 because that's the equilibrium point, the level where enough supply appears to absorb JPMorgan's buying without the market going completely vertical. Anything below $412 and there aren't enough sellers. Anything above it and the buying panic accelerates and we go to 600,800,1000. $412 is the controlled explosion price, the level where JPMorgan can cover as much as possible without triggering total systemic collapse. Now here's where it gets truly insane. JPMorgan isn't the only short. They're the biggest, but they're not alone. According to the latest bank participation reports and CFTC data, there are at least 4 other major banks with significant silver short exposure: Citigroup, HSBC, Bank of America, Goldman Sachs. Combined, these banks are short an additional 2 to 3 billion ounces. So the total Western banking cartel short position is somewhere around 8 to 9 billion ounces. If JPMorgan starts covering, if they begin buying aggressively and driving the price up, the other banks will panic. They'll see what JPMorgan is doing and realize that if JPMorgan is covering, the game is over. And they'll rush to cover too. Because nobody wants to be the last short. The last short gets executed. The last short always pays the highest price. And that's why you're about to see a race, a stampede. All 5 major short banks trying to cover at the same time. 8 to 9 billion ounces of buying pressure crashing into a market that can supply maybe 300 million ounces a year. That's not a short squeeze. That's a black hole. A gravitational collapse. Prices don't rise in a straight line. They go exponential. They go vertical. They gap higher. And that's why I'm telling you with absolute certainty, do not sell at 100. Do not sell at 200. Do not sell at 300. Because once the covering truly begins, once JPMorgan starts executing this plan, the price will move faster than human reaction time. You'll wake up one morning and silver will be at 150. You'll think I should sell. But before you can log into a dealer's site, before you can pick up the phone, the price will be 200 and by the afternoon, 250. This won't be a slow grind. This will be a moonshot, a rocket, a full-blown mania phase. And if you sell early, if you hand your silver to JPMorgan at 100 or 150, you'll watch it run to 412 and realize you were robbed. You sold your lottery ticket for spare change when it was worth a fortune. Now, let me show you what the memo says about execution strategy because this part matters. This tells you exactly how JPMorgan plans to cover and what warning signs to watch for. The memo lays out a 6-month execution timeline. Month 1, January 2026, which is now, JPMorgan starts with non-market purchases. That means buying directly from miners through private negotiations. It also means quiet deals with sovereign entities willing to sell discreetly. This phase is designed to be invisible. No large COMEX orders, no obvious buying pressure, just silent accumulation of 200 to 300 million ounces from sources that can deliver massive blocks without triggering price spikes. Month 2, February. They shift into controlled market purchases. JPMorgan begins buying COMEX futures and standing for delivery, but carefully 500 contracts per day, then 1000. Enough to start covering, but not enough to panic the market. They expect to add another 200 to 300 million ounces this way. By the end of month 2, they'll have covered roughly 500 to 600 million ounces total. That still leaves about 5.6 billion ounces to go, but the price will already be moving. February is when the market starts noticing. Premiums rise. Delivery times stretch. Retail buyers realize dealers are running tight on inventory. Month 3, March. This is where it turns aggressive. The memo calls it the accelerated covering phase. JPMorgan ramps up to buying 2,000 to 3,000 contracts per day on COMEX. They're also unwinding massive OTC swaps with other banks. They're bidding on every large block that comes to market, and the price will reflect it. March is when silver breaks 100, then 120, then 150. Volatility explodes. $10, $15, even $20 moves in a single day. This is when weak hands panic, retail investors sell, industrial users dump excess inventory, and JPMorgan absorbs it all. By the end of March, they've covered maybe 1.5 billion ounces, still 4.7 billion short, but the stress is spreading. The other short banks are starting to feel the squeeze. Month 4, April, is the critical phase. This is when the CFTC's 90-day deadline arrives. JPMorgan must prove they've reduced their position by at least 50%. They need to be down to 3.1 billion ounces or less. So April becomes maximum intensity buying. They're buying everything COMEX OTC private deals. They're outbidding China for London Vault metal. They're pulling metal out of ETFs through redemptions, and the price is now firmly in the 200 seconds 220, 250, 280. Every seller that appears gets taken out instantly. April is also when the other banks join the scramble. Bank of America starts covering, Citigroup starts covering. Now you have 5 major banks buying at the same time. The market turns into a feeding frenzy. Month 5, May, is the completion phase. JPMorgan has now covered roughly 3.5 to 4 billion ounces. They've satisfied the CFTC. They've secured enough metal to meet near-term delivery obligations, but they're still short 2 to 3 billion ounces. And the price is now in the 300 seconds, 320, 350, 380. This is when the algorithm's $412 target comes into clear view. May is when JPMorgan makes the final move. They need to lock in forward supply from miners for the remaining exposure they can't close in the spot market. So they offer long-term contracts to major miners. 5-year deals at $412 per ounce. The miners accept. $412 is 5 times the historical average price. It's guaranteed revenue that turns every marginal project profitable. By the end of May, JPMorgan has effectively neutralized the position. They've covered about 4 billion ounces in the market and locked in multi-year forward contracts for the remaining 2 billion. Their net exposure is now survivable. The existential threat is gone. And silver, after absorbing 4 billion ounces of buying in just 5 months, has reached the target price of $412. Month 6, June, is the stabilization phase. JPMorgan stops buying. The price stops climbing and begins consolidating around $412 as the market tries to process what just happened. Analysts publish reports claiming silver is overvalued. Mainstream financial media calls it a bubble, but the price doesn't collapse because the underlying forces haven't changed. China is still buying, industrial demand is still accelerating, and now, with JPMorgan and the other major shorts out of the game, the selling pressure is gone. The manipulation is gone. The natural supply and demand equilibrium for silver is $412. That's the new normal. That's the price where supply finally meets demand in a world without massive, naked short positions sitting on the market and suppressing it. Now, here's what you need to understand about the timeline. You are in month 1, January, right now, today. JPMorgan started executing this plan yesterday, January 6th. That's what the memo date says, 4:47 a.m. They're already buying. The purchases have begun, and you have 5 months. 5 months before we hit $412. 5 months to position yourself, 5 months to accumulate physical silver before it becomes unobtainable. Because once we enter month 3, once March arrives and silver is at $150, the retail panic starts. Dealers get wiped out, premiums blow out, delivery times stretch to 6, 8, 1, 2 weeks, and by month 5, by May, you won't be able to buy physical at any price. The market will be frozen. Every ounce will already be spoken for. Miners will have sold their entire forward production to JPMorgan and the other banks. There will be nothing left for retail. So your window is now January, February, maybe early March. After that, you're too late. Let me address the obvious question. Skeptics will ask if JPMorgan is covering why has silver only moved from 70 to 80? Why isn't it already at 200 or 300 if this massive buying campaign has started? The answer is in the memo. Month 1 is non-market purchases. JPMorgan isn't buying on COMEX yet. They're buying privately off exchange from miners, from sovereign entities, from large holders willing to sell quietly without moving the quoted market price. This is the stealth phase, the phase where they gather as much metal as possible at today's prices before the market realizes what's happening. But stealth only works for so long. By February month 2, they have to start buying on COMEX. They have to start taking delivery. And that's when the price begins to move. That's when the world figures out something has changed. JPMorgan, the biggest silver short in history, has flipped. They're no longer selling. They're buying. And once that realization spreads, once the silver community, institutional investors, and algorithmic trading systems all recognize that the biggest seller has become the biggest buyer, the price will gap. It will jump $10, $20, $30 in a single day because the order book is thin, the market isn't liquid, and if everyone tries to buy at once, there are no sellers. The price has to rise until sellers appear. So, yes, right now, in early January, the price is still in the 80 seconds. But that's the calm before the storm. That's the last moment of normality, the last chance to buy silver at prices that in hindsight will look absolutely insane. In 6 months, when silver is at $412, people will look back at January 2026 and say, I can't believe silver was available at $80. I can't believe I didn't buy everything I could at 80. But most people won't act. Most people will wait for proof. They'll wait for the price to start rising before they buy. And by the time the proof is undeniable, by the time silver is at 120 or 150, it will be too late. Premiums will be $50, $80, $100 over spot. Dealers will have no inventory. The people who waited will be priced out. They'll become permanent spectators watching from the sidelines as silver runs to $412 while they own none of it. Don't be one of those people. Don't wait for confirmation. The memo is the confirmation. JPMorgan is covering 6.2 billion ounces. They have 6 months to do it, and the target price is $412. That's not speculation. That's JPMorgan's own internal risk analysis. They're the most sophisticated commodities trading operation on the planet. They controlled this market for 15 years. They know silver better than anyone. And they're telling you through this memo that $412 is where we're headed. Believe them. Act on it. Buy physical silver right now, today, this week, as much as you can afford, because this is the last time in your life you'll be able to buy silver at double digits. The next time silver is truly for sale, the price will have a 3 in front of it or a 4. And by then, your opportunity will be gone. Now let me talk about the paper trap, because this part is critical. Right now, you can buy COMEX futures at $80. You can buy SLV shares at a price that roughly follows spot. And some of you are thinking, why buy physical at 95 or 100 when I can buy paper at 80? Because paper is a trap. Paper is going to zero. Let me explain what's about to happen to the paper-silver market. When JPMorgan starts covering in earnest, the COMEX futures market depends on liquidity. It depends on sellers appearing when buyers need to buy, and buyers appearing when sellers need to sell. But when the biggest seller in the market, JPMorgan, turns into a buyer, and when the other short banks also become buyers at the same time, the sellers disappear. The only sellers left are speculators, trend followers, technical traders, and those sellers will get steamrolled. They'll sell at 85 and watch it go to 95. They'll sell at 100 and watch it go to 120. Every seller will be wrong. Every seller will miss the move. And eventually sellers stop selling. They step aside, and when there are no sellers, the market can't function. At that point, the COMEX will face a choice. Either the exchange lets the price go vertical, gapping to 300 or 400 or 500 inches a single session, or it halts trading, invokes force majeure, and declares an emergency. And I'm telling you, based on history, based on what happened in nickel, based on what happened at the LME COMEX, will halt. They will declare force majeure. They will announce that silver futures contracts are being cash settled at a reference price, and that reference price will be nowhere near the real physical price. It will be some average of recent trading, maybe 150 or 200, while physical silver trades at 400. So futures holders get cashed out at 200, they get wrecked, they get robbed. Lawsuits follow, and those lawsuits take years. And by the time anything gets resolved, the opportunity is gone. But physical holders will have $400 silver in their hands, real metal. No counterparty risk, no forced settlement, no exchange games. The metal is theirs, and the metal is worth $400. That's the difference between paper and physical. Paper can be seized. Paper can be cash settled. Paper can be manipulated. Physical can't. Physical is yours. That's why you have to buy physical. Don't buy SLV. Don't buy COMEX futures. Don't trust any paper promise. Buy bars, buy coins. American Silver Eagles, Canadian Maples, Britannias, Krugerrands, Austrian Philharmonics, anything that's government-minted silver with a recognizable hallmark. Or buy bars 1 ounce, 10 ounces, 100 ounces, whatever you can afford, and take delivery. Put it in a safe. Put it in a vault. Put it somewhere you control. Because when JPMorgan is finished covering when the price is at $412, you're going to want to be holding the real thing, not a paper claim, not an ETF share, the metal. And that metal is going to be worth more than you ever imagined. Because $412 isn't the end. $412 is where JPMorgan's covering takes us. But once JPMorgan is done, once the shorts are cleared, silver doesn't just drop back down. It stays elevated because the fundamentals haven't changed. China is still buying. Industrial demand is still surging, solar panel production keeps exploding, the deficit keeps growing, and with the shorts gone without the old selling pressure, the price rises to reflect real scarcity. And true scarcity in a world that consumes roughly 1 billion ounces of silver per year while producing only about 850 million points to prices far above $412. Some analysts believe silver could reach 600, others say 1000, some even argue for 2000. I don't know where the ultimate peak will be, but I do know this $412 is not the end. $412 is only the beginning. So here's your call to action. This is what you do right now, today, this moment. Step 1, stop waiting. Stop searching for more confirmation. Stop trying to time the perfect bottom. The bottom is now. $80 is the bottom. This is likely the lowest price silver will ever trade at again. Step 2, buy physical. Call dealers. Order online. Buy whatever inventory they still have. Pay the premiums. Yes, premiums are high, $10, $15, $20 over spot. Pay them anyway. In 3 months, premiums will be $50 over spot. In 6 months, there won't be a premium at all because there won't be any physical silver available at any price. Step 3, take delivery. Do not leave your silver with a dealer. Do not store it in someone else's vault. Take possession, have it shipped to your home, put it in a safe, control it yourself. Because if the system breaks, if COMEX defaults or a force majeure event is declared, you do not want your silver trapped in another party's custody. Step 4, hold. Do not trade it. Do not try to flip it for a quick gain. Hold through the volatility, through the wild price swings, through the fear and doubt. Hold until JPMorgan's covering is complete. Hold until we reach $412. And even then, don't sell everything. Keep some because after $412, the price goes higher. This is not financial advice. This is a war report. This is intelligence from the front lines. JPMorgan has surrendered. The memo proves it. 6.2 billion ounces. 6 months. $412. The final boss has fallen. The manipulation is ending. The price is about to explode. And you have one chance, one narrow window, to put yourself on the right side of the greatest wealth transfer in the history of commodity markets. The time for debate is over. The time for endless analysis is over. The evidence is in. The plan is clear. JPMorgan is buying, and you should be too. Don't wait. don't hesitate. Don't let fear, doubt, or skepticism stop you from acting. Because 5 months from now, when silver is at $300 and still climbing, you'll wish you had acted today. You'll regret every ounce you didn't buy. Don't let that happen. This is your moment. This is your signal. The alert has been issued. $412. 6 months. The countdown has begun. Go. Go now. Buy silver. Buy physical. Hold it and watch as JPMorgan's forced covering carries silver toward the promised land. The war is over. We won. Now claim your victory.